Hello and welcome to this 22nd post of Investing Not Rocket Science. Wish you all a happy Friday and a good weekend ahead. Investing doesn't have to be rocket science, and this is our non expert guide to portfolio management. Quick recap of the series so far. In the first post, I defined a basic portfolio framework. The object of this $1 million portfolio is to beat inflation and an equity index. The investment style presented here is an active portfolio management without the use of leverage and a time horizon greater than 5 years. There are usually two posts a week, Monday and Fridays. From episodes 2 to 22, I have evaluated 67 stocks, 4 potential bond additions, and this portfolio is long 15 stocks, 1 bond, and short 1 stock. You can read all about it in the previous posts on our website www.claritech.app. Today we're going to look at a summary of the recent quarterly earnings announcements, particularly of the corporates in the portfolio or in the watch list. Before we dive into the summary, a few questions that needs to be answered. What are quarterly earnings? Quarterly corporate earnings refer to financial results of a company over a period of 3 months. These results typically include revenues, expenses, and net income, and they are reported by publicly traded companies to their shareholders and the public. Is it important? Importance depends on the context. For shareholders, these earnings can be a key metric for evaluating a company's financial health and growth potential. Positive earnings reports can lead to increased investor confidence and a rise in the company's stock price. Negative reports, on the other hand, can cause the opposite effect. It can be an important indicator of broader economic trends as well. For example, if many companies in a particular industry report strong earnings, it may suggest that that industry as a whole is performing well. While it might not be the only metric to consider while evaluating a company or the economy, it is an important factor in decision making for investors, analysts, and other stakeholders. What does it mean when a company beats or misses or even meets expectations? This refers to the company's actual financial performance for a given period compared to the expectation of financial analysts. This is usually measured in the terms of revenue or earnings per share or other financial matrices. For example, if a company was expected to report an earning of $1 a share for the quarter, but instead reports an earning of $1.20 per share, this would mean that the company has beaten expectations. It can be seen as a positive sign for investors, and it suggests that the company is performing better than expected. On the other hand, if a company was expected to report revenues of 10 million for the quarter, but instead it reports a revenue of 8 million, this company would be considered to have missed expectations, and it can be seen as a negative sign for investors, and it suggests that the company may be underperforming or facing challenges. All right. 10 terms that are typically used to understand corporate earnings. One is revenue, which is the sum of all income included in the company's operating activities. And revenue growth is a percentage growth in revenue in a period compared to a prior period. For example, quarter on quarter or year on year. Operating income and operating income margin. Operating income refers to the income after reducing all the operating expenses. And operating income margin is the operating income as a percentage of the revenue in that quarter. Net income to common shareholders. This represents the profit or loss available to shareholders after adjusting for preferred dividends. What is shareholder yield? This metric measures the return that shareholders receive from a company in the form of cash dividends or stock buybacks or debt reduction. PE ratio or price earnings ratio is the market capitalization of a company divided by its earnings. It represents the earnings multiple an investor is willing to pay for one share of the company. Earnings yield is the inverse of the PE ratio. Levered free cash flow is a sum of cash from its operations and, in addition to this, the capital expenses. Free cash flow yield measures the amount of free cash for each dollar of market cap or for every share. held by the shareholder. All right, let's dive into some of the results that were announced um, this week, Monday to Thursday. Bank of America posted earnings of $0.94 per share and revenue of 26.3 billion, beating analyst expectations on both. Trends in financials show improving revenues, net income, and revenue growth. You can see that here. Operating income margin and earnings yield as well. Shareholder yield has fallen, and so has free cash flow yield. Goldman Sachs posted an earnings of 8.79 US dollars per share and a revenue of $12.2 billion for the quarter. It beat analyst expectations on earnings per share but missed on revenues. Trends in financials show improving revenue growth and shareholder yield. It's improving revenue growth and shareholder yield. Trends in net income sees declines. Operating income margin sees declines. And earnings yield is seeing a decline as well. And so has the free cash flow yield. Goldman Sachs also took a loss of 470 million on the partial sale of its personal loan book called Marcus Loans. Okay. Morgan Stanley posted earnings of $1.7 per share and revenue of 14.5 billion for the quarter, beating analyst expectations on both. Trends in financials sees declines in operating income margins. That's there. And net income as well as earnings yields seeing some sort of a decline. Shareholder yield sees improvement and revenue growth is flat compared to the previous quarter. Right. Revenue growth remains flat. It's kind of struggling with its free cash flow yield as well. Okay. While income from the investment banking dipped, it saw growth of 11% from its wealth management business. And stock trading revenues and fixed income revenues fell 14 and 12% respectively. According to the chief financial officer, the outlook for the remainder of this year is difficult to predict. Okay. ASML Holdings posted earnings of $4.96 per share and revenue of 6.74 billion US dollars for the quarter. Beats on EPS and earnings per share and misses on revenues. Trends in financials see growth in revenues and net income and in revenue growth as well. Operating income margin and earnings yield are flat compared to the trailing 12 months in the last quarter. The company said in its earnings call that it's seeing adjustments to client orders, but it maintains a overall positive outlook since the demand exceeds its capacity, and the company has an order backlog of about 40 billion euros. Okay. Although not a part of this portfolio or um, the watch list, but needs some mention. Netflix posted earnings of US dollar 2.88 per share and revenue of 8.16 US dollars billion US dollars for the quarter. Results were mixed. It beat analyst expectations on earnings per share but missed on revenues and subscriber growth. Trends in financials show improving revenues and free cash flow yields. You can see the free cash flow yield rising there, and revenue is continues to rise. Okay. It sees some decline in net income and revenue growth and operating income margins and earnings yield, as well as shareholder yield. So it's seeing some declines in quite a few matrices. The firm is expected to roll out its password sharing crackdown in Q2 this year. Canada is likely to serve as a template, possibly, where the company has seen growth in its subscriber base and revenues after launching a paid sharing plan. Netflix is also winding down its DVD mailing business, the segment that began this entire company, in which the company would mail discs to customers in red envelopes. Netflix also intends to begin an ad supported plan. Okay, in addition to this, Rio Tinto, some companies do not need to post quarterly earnings. Instead, they post half yearly earnings, but they may post expectations or actuals of revenue or top line. So, Rio Tinto is one such company which has announced its first quarter production data. The company saw increases in production compared to Q1 last year, but it saw production declines in almost every segment compared to the last quarter. The company also reduced its total production outlook for copper this year. All right. Now, the question, what about Tesla? Tesla posted an earnings of $0.85 per share and revenue of 23.3 billion US dollars in this quarter. Missed analyst expectations on both, although not by much. The stock closed lower by nearly 10% yesterday, bringing its market cap to $516 billion dollars from $572 billion dollars. Trends in financials show improvements in revenues and in earnings yield. That's here. Net income and shareholder yield remains flat. That's here. Compared to the trailing 12 months in the last quarter. Trends see some declines in revenue growth and a slight dip in operating income margin. Okay. Free cash flow remains positive, although sees a decline in this quarter compared to the last quarter. In other financials, while the revenues have increased quarter on quarter, inventories have also increased, however, not at the same pace as the revenues. Total debt, on the other hand, has come down compared to the previous quarter. What investors are concerned about is that revenues and margins and net income and free cash flow have all dipped quarter on quarter. However, vehicle deliveries have increased for Model 3, which accounts for about 95% of the deliveries, compared to Q4 2022, which probably means that the price reductions are showing some traction. The company maintains its outlook that it would deliver 1.8 million vehicles this year and would continue to grow at about 50%. The Cybertruck model is also expected to be rolled out this year. Tesla is currently trading at a price-earning ratio of 43, up from 34 in the last quarter, but down from a peak of about 1,000 in January 2021. I've covered Tesla in previous posts. It is not a value stock and cannot be seen in the same lens as a value stock. It's a growth stock. While the stock is expensive currently, but it could possibly be a tactical buy at 150. More on this next week. This is Investing, Not Rocket Science, a series on building and managing an investment portfolio. None of this is expert advice. I'm just learning alongside you. You can reach out to us on any of our social media channels or visit the blog, read the blog on our website, www.privatetech.app. Thank you very much for watching, and I look forward to seeing you in the next post. Bye-bye.